Most beginners focus only on finding the perfect strategy, but even the best strategy is useless without proper risk management, because in trading, you can never completely avoid losses. That's why risk management is the key factor to long-term profitability. Trading isn't about winning every trade, it's about protecting your capital so you can take the next one. In this video, I'll show you what risk management really is and how you can start applying to your own trading. Hi, my name is Matthew and this is Focus Charts. So what exactly is risk management and why it is important? Risk management is one of the most important things in trading. It basically prevents you from blowing up your account in one single trade. Because even if you have, let's say, 80% win rate strategy, that would mean 8 out of 10 of your trades would be winners, but there are still 2 trades that are losers. And if you risk too much, you can easily wipe your account very quickly. Think of risk management like a seatbelt in a car. A seatbelt won't prevent accidents from happening, just like risk management won't stop you from having losing trades. But when the accident comes, it can save your life. In trading, risk management saves your account. I've mentioned a 80% win rate strategy earlier, but that was more of an extreme example. In reality, your win rate will be probably much lower. And that's completely fine as long as you manage your risk properly. To show you why, let's look at this table. It shows the probability of having a certain number of losing trades in a row based on your win rate. On the left, you can see the win rate of your strategy. Across the top, you can see the number of consecutive losing trades. And the numbers in the cells show the probability of having that many losers in a row within just 100 trades. For example, even with a 50% win rate, which sounds decent, there's a 95% chance you'll get at least 4 losing trades in a row, and more than 75% chance of 5. With 70% win rate, you still have a 73% chance of 3 losers in a row. And even with a very high 90% win rate, there's still almost a 40% chance you lose 2 trades back to back. The point is, no matter how good your strategy is, losing streaks are guaranteed. And if you risk too much, just one of these streaks can wipe out your account. And that is why risk management is the key to surviving long enough to actually become profitable. So now, let's break down the main principles of proper risk management. First, it's necessary to stay consistent with the amount of money you risk per trade. If you're inconsistent, that table I showed you earlier becomes meaningless. For example, on the first trade, you risk 3% of your account and it's a loser. Now, you're down 3%. On the next trade, you risk 2% and it's another loser. Now you're 5% in drawdown. On the third trade, you get scared and risk only 0.5%. This time, it's a winner. But if you've done the math, you'll see that unless this trade had a 1 to 10 risk to reward ratio, you're still in a drawdown. And even if it did, which probably not, you're only back to break even. Now let's see how this would look if you risk the same amount of money on every trade. For this example, let's assume the winning trade had a 1 to 3 risk to reward ratio and the account size is $100,000. These tables, the one on the left shows what happens when you don't follow strict risk management, and the one on the right shows what happens when you risk the same amount on each trade. As you can see in the left table, we end up down by $3,500. But in the right table, with consistent risk, we actually end up in $1,000 profit. That means the key to profitability is keeping your risk consistent. In the example where we were inconsistent, we risked 3% on a single trade, and that's just too much. I recommend risking only about 1 to 2% of your account per trade. Of course, this depends on you, your strategy and your trading style. If we go back to this table, you can see that the higher your win rate is, the lower the probability of a long losing streak is. So if you know your strategy has, let's say, an 80% win rate, you could technically afford to risk a bit more, since the chance of consecutive losses is smaller. But again, I wouldn't recommend it. For example, my own strategy has almost 75% win rate, which is very high. And even then, I still risk 1% per trade every time. Consistency in risk isn't just about picking a number like 1% or 2%. It's about actually controlling your trade so you never risk more than that. And the tool that makes this possible is the stop loss. As the name suggests, it's a tool that automatically closes your trades if the price moves against you. You set it the same way as your take profit, but in this case, if it gets triggered, you would take a loss. Now that might sound like a bad thing, but it's actually one of the most important tools in trading. A stop loss is what keeps a single trade from turning into a disaster. Without it, one wrong move in the market can wipe out your account. Stop loss is also the key factor when you are calculating your position size, because before you open any trade, it's necessary for you to exactly know where you want to enter and where you want to close it. In other words, where is your stop loss and take profit. Even then, you can calculate your position size, and that is where you'll define how much money you're willing to risk on a single trade. To make this more practical, let me also show you a very useful tool in TradingView. If you don't know, TradingView is a software that is used by many traders to do technical analysis. There's a detailed video about it on my channel, so you can check it out. But back to this topic. The tool is the long-short position measuring tool. You can place it directly on the chart to plan your trade. It shows your entry, your stop loss, and your target. This way, you can visualize your risk to reward ratio before you even place a trade. And here's how it works. The green box shows your potential profit target, the red box shows your stop loss, and the entry line is where you plan to enter the position. As you can see, this box shows your risk to reward. For example, if your stop loss is 1% below your entry and your target is 3% above, your risk to reward ratio is 1 to 3. That means you're risking $1 to potentially make $3. Using this tool before you place an order helps you to visualize your trade and to check if it actually makes sense. Because in trading, it's not about being right every time. It's about making sure your winners are bigger than your losers. Okay, knowing where to place your stop loss is only half of the equation. The other half is calculating the right position size. So you risk exactly the amount you want. No more, no less. The size of your position depends on 3 things. How much money you want to risk on the trade, the distance between your entry and your stop loss, and the value of a pip or a tick depending on the market you trade. The formula is simple. Position size equals to risk per trade divided by stop loss distance times pip or tick value. If you don't know what a pip or tick is, it's simply the smallest standardized price movement. A pip in CFDs and a tick in futures. I'll make dedicated videos about both later on. Now I'll show you an example. Let's say your account is $10,000 and you want to risk 1%, so it's $100. Your stop loss is 50 pips away and the pip value is $1. That means 100 divided by 50 times 1 equals 2. So you should open 2 lots to risk exactly $100. In futures, it's the same idea, just with ticks instead of pips. For example, on the E-mini Nasdaq 100, one tick is worth $5. If your stop loss is 20 ticks away, that's $100 risk per contract. So in this situation, you would open 1 contract position. Don't worry if you right now don't know the terms like lots or contracts, I'll explain them in upcoming videos. And of course, you don't have to calculate this manually every time. There are free position size calculators online, and some brokers or platforms even have them built in. So to wrap this up, risk management is not the most exciting part of trading, but it's the part that keeps you in the game. It protects your account and gives you the chance to actually become profitable in the long run. Remember, it's not about winning every trade, it's about surviving the losing ones. Okay, if you find this video helpful, leave a like and let me know in the comments how you manage your risk. And of course subscribe so you don't miss the next video, where we'll dive even deeper into the skills you need to grow as a trader. Thank you so much for watching and stay focused on charts.